Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. As we approach the end of the year, many of the miseries that investors feared did not take place. Instead, the S&P 500 is near record levels, inflation is subsiding, the economy is growing steadily, and the Fed has begun to cut interest rates. This is a reminder that excessive worry can lead investors to make decisions that may not serve their long-term interests. A stronger than expected economy has supported all asset classes. A year ago, investors spent much of their time worrying about a hard landing as the Fed kept rates high to fight inflation. Fortunately, this never materialized. Instead, inflation is returning to pre-pandemic levels. The job market is healthy, and economic growth is steady. Few investors expected such a positive scenario 12 months ago. Unemployment remains low at only 4.2%, and 2.3 million new jobs have been created over the past 12 months. GDP growth, at 2.8% in the third quarter, has been stronger than many economists anticipated. This does not mean there are no challenges ahead. Consumer spending could slow as excess savings are spent, and debt levels are high for both households and businesses. Assets that have risen sharply could experience greater volatility as well. In times like these, focusing on fundamentals such as earnings and valuations will be important. Expensive stock market valuations underscore the need for portfolio management. One reason for higher stock prices is the strength of corporate America. Corporate earnings have grown 8.6% over the past 12 months, rising to $236 per share for the S&P 500. Valuations matter because paying a higher price today means, all else equal, a lower return in the future. For investors, this has two implications. First, it's important to construct portfolios by balancing stocks with other asset classes, such as bonds and international investments. Second, with stock market indices at historically expensive levels, it's critical to focus on more attractive parts of the markets. For example, while artificial intelligence stocks have driven market returns over the past 2 years, many other parts of the market have performed well recently. Year to date, all 11 sectors have generated positive gains. Given that it is difficult to predict which sectors may outperform each year, having an appropriate allocation to many parts of the market can help to stabilize portfolios. The Fed is expected to cut rates further. The Fed began to cut policy rates in September after months of investor speculation. So far, the Fed has lowered rates by 0.75%, with markets expecting 3 or 4 more additional cuts by the end of 2025. The timing and magnitude of these rate cuts remain uncertain and will depend on the economic data. Regardless, the monetary policy headwinds that began in 2022 are now turning into tailwinds. Just as higher rates slowed economic growth and led to investor concerns, lower rates can help to stimulate the economy, supporting both corporate earnings and possibly stock market returns in the long run. For investors, what matters is not trying to guess each move by the Fed, but the overall path of rates. In 2025, investors should put politics aside as they construct their portfolios and financial plans. As is always the case, working with a trusted advisor is the best way to ensure that your financial strategy considers tax implications and changing market conditions. When it comes to debt ceilings and the growing federal deficit, there are no simple solutions. The national debt has grown to $36 trillion with no signs of slowing. Without a sustainable path, interest payments on the federal debt will continue to rise. Credit rating agencies may continue to question the quality of U.S. debt, and the role of the U.S. dollar as the world's reserve currency could become uncertain. Without minimizing the severity of this topic, it's important to recognize that we are not at a tipping point just yet, and markets have historically performed well, regardless of the level of the deficit and national debt. Long-term thinking will be key to success in 2025 and beyond. Perhaps the most important lesson of 2024 is that markets can perform well in spite of investors' worst fears. For example, market pullbacks in April and August this year may have led some investors astray, despite positive gains throughout the year. Markets have shown remarkable resilience over the past 12 months, supported by economic growth, innovation, and positive trends across many asset classes. It's important to celebrate these positive outcomes, while also remaining vigilant and focused on the long term. The accompanying chart shows the value of having a long-term perspective. History reveals that true wealth is created not over months, but over years and decades. Even for those already in retirement, Having a longer-term perspective allows investors to put short-term events in context and make productive decisions. The bottom line? As the year comes to a close, we can celebrate a strong year for markets. In 2025, investors should focus on finding balance in their portfolios. History shows that this is the best way to manage unforeseen events while staying on track to achieve long-term financial goals. Thank you for listening. For additional information, please visit mraadvisory.com.